Good afternoon or morning to everybody out there. This is Adam. We are awaiting Jason. I believe he's probably running a little late from a meeting or something, but he'll be with us today. But we have another live stream planned that I think you're all going to look forward to. So Jason threw this graphic in. Think you'll enjoy it. So some people there saying we'd really like to see something at a higher price point, and the
I'm
agent,
here.
hey, I can show you the house tomorrow. You gotta love it.
That is, Adam, that is such a telltale sign of the way the market is now, isn't it?
It's it's on up there, that's for sure. It's man, it's incredible. You get the I want this property. Well, that's nice. That was $10,000 ago. That was $20,000 ago.
I got to tell you, by the way, Adam, is this microphone?
Yes, that's the one.
Good. Thank you. See, we got to, folks. This is a very homespun show here. We're like real. We're gritty. This is it. Okay, so I got to tell you a funny story about this. Right when I saw this meme, I thought this is so telling. I'm selling. I've been selling several of my properties and buying other properties to do 1031 exchanges. And one of my Florida properties, the deal keeps falling out. This deal, I don't know, this house, I keep selling it and then I have to sell it again. I don't know. It's just problematic. So every time we resell the property, a couple days later, it sells for more than the previous time.
It's a hard life, Jason.
Yeah, it's incredible. I'm like, what's the urgency here? If I just wait a day, I'll get $5,000 more. It's and that just shows you folks that this market is bordering on psychotic. Okay, it really is. But that does not mean there's a bubble. And we'll talk about some of that stuff today. And the reason there's not a bubble is because there is a structural shortage, and because housing, when priced in comparison to many other things in the world, is actually historically cheap. Believe it or not. I know. If you haven't seen our other live streams or other YouTube videos or listened to the Creating Wealth podcast, you may not be aware of this. But if you are in the know, you know what we're talking about, because people think it's expensive because they're only comparing it to dollars, and they're only considering the entire price of the property rather than the monthly payment on the property, which is incredibly cheap. Adam?
Yeah, I would agree. I mean, it's like we've talked about before, price run up does not equal bubble. Yep. Bubbles happen whenever the fundamentals don't sustain what's happening, and the fundamentals do sustain what's happening. So
yep, you got that right. Let's take them to the next slide. So this I wanted to show, Adam's got a whole presentation for you today, but I'm just wanted to throw in a few odds and ends here at the beginning. This was fascinating. I posted this in our Empowered Investor Inner Circle, which, by the way, if you want to learn more about that, reach out to one of our investment counselors or just go to empoweredinvestor.com.
Empowered REI, I thought.
Well, I hesitated when I said that because I'll check in a minute, but he was supposed to update that link. Let's see. And he, meaning Brian, our team member, no, Empowered REI, you are correct. He has not updated that link. So Empowered REI meaning real estate investor or investing. And you can learn about that. But this is fascinating. Adam, when you saw this, did it just blow your mind? Because visually speaking, look at this. With $50,000 in lumber, this is what you could do, right? A year ago, you could build 10.5 houses. Today, only 2.5. I mean, that should just really give you a very good perspective as to what is happening out there. It's absolutely, or no, not 2.5, 2 1/10 houses today versus 10 and
a 20th.
10 and a 20th. Okay, that's
still
really, folks. The U.S. has a lot of things right, but it needs to go to the metric system and use decimals. Much better system than fractions and the imperial measurement. A pint is a pound the world around, but the metric system is just way better.
Good luck with that.
Yeah, I know. Good luck getting it changed. And people in all those English Commonwealth countries need to start driving on the right side of the road. So there. That's my editorial on that. Amazing info, though. What I wanted to say on the tech giants is, folks, these are the new modern tyrannical dictators, the oppressors, the robber barons of our era. Look, I'm a capitalist, okay? Believe it or not, I may not sound like one all the time, but this is just rational. This is a ridiculous concentration of wealth, folks. And these companies have a ridiculous amount of control over our life, over what we think, what we say, what we can read. Amazon has banned all sorts of books. It is just disgusting what is going on. I mean, it's like, why aren't people outraged like they are when they look at history and they look at the Nazis and they look at Chairman Mao and Stalin and all of these evil dictators of the past? It's basically what we have. We just have a different version of it today. Read 1984, read Brave New World. Well, you can still get those books, right? You may not even be able to get them, but it's absolutely scary stuff. This is how much money they make per minute. So Amazon is making over $800,000 a minute.
I mean, Netflix is making the roughly the median U.S. wage every minute.
That's a good. I'm glad you made that comparison, Adam. That's a really good comparison. Yeah, it's absolutely scary, the kind of power these companies have, and I would not complain about it if, number one, they weren't suppressing thoughts, if they weren't acting like the thought police, and number two, if they weren't just rolling over their competitors and using all sorts of unfair tactics to put their competitors out of business, which they are, and if there were a free marketplace where there were lots of choices. But we don't have any of that. We don't have it.
Yeah. Just want to say hello to All Nighter Hider. Welcome back. San Diego in the house, he says. So Everybody else, let us know where you're watching from.
Yep. And let us know where you're watching from. And please do us a favor, because we'd really appreciate it. And hit the like button. And make sure you subscribe and your notifications are on if you're watching on YouTube. Thank you, All Nighter, for hitting the like. We appreciate it. And comment below. Let us know where you're watching from or listening from. So, Adam, this does not come as a surprise, does it?
No, so low tax states are winning the real estate battle. Nevada, Florida, South Carolina, Texas top the list of states attracting new residents. Shocking. Yep. Shocking, I say. I'm sure you haven't noticed any new neighbors. I definitely haven't noticed any new neighbors here in Texas.
You're being sarcastic, right?
Oh yeah.
Of course, yeah. Yeah, it's absolutely amazing. That show I did when I interviewed Meredith Whitney on the podcast, 6-7 years ago.
Wow.
Oh, look, we got people from all over the world. Like always, it's so great to have you. We'll get to you in a minute. But Meredith Whitney wrote that book, The State of the States. And it basically talked about people essentially voting with their feet. And that's what they're doing, folks. It feels like the whole world is moving to my home state of the last 3 years, Florida. But Texas, where Adam lives, it's just incredible how this migration, and this ain't going to change anytime soon. It's really something.
Yeah, it's not like the pandemic. It was already happening, and the pandemic just turbocharged it. And it's kind of, it's pretty crazy what's going on. Really so, these are, now I'm not saying that, we're not saying you should definitely invest in all 4 of these states, but they're a good start, because, some of the markets inside of those states may be, a little too cyclical, a little too overpriced potentially, but these are good starting points for, where to look at.
And what Adam is talking about when he says cyclical is, we don't like cyclical markets. We divide the world into 3 types of markets: linear, well, not with my thumb, linear, cyclical, and hybrid markets. And we like the linear, and now almost every market has at least temporarily become hybrid, I'd say. Would you say that, Adam?
Yeah, I call Florida the hybrid state at this point.
Yeah. Yeah, that's a good way to put it. I agree. And if you want to know more about this stuff, again, we of course don't have time to sort of recover everything we've covered on many prior episodes, live streams, podcasts, YouTube videos. Just check out the other material, and you'll get full in-depth explanations of linear, cyclical, hybrid, my refi till you die wealth extraction strategy, my inflation-induced debt destruction strategy, all of this stuff. It's all there. It's all free. So take advantage of it. Be sure to subscribe, hit the like button, and turn on your notifications as well. Adam, we got a whole bunch of people commenting where they're from.
Yeah. Phil, I just want to address Phil H here real quick. He said, Las Vegas here. When should I buy a house? Phil, clarify if you're talking about to live in or to invest in. That's that could change the answer significantly. But we've got people from New York, India, Hawaii, New Jersey, Istanbul, Phoenix, San Diego. We're all over.
Yeah, this is great. I love that the international audience. That's fantastic. And yeah, it's good to have all of you. Keep the comments coming. We love hearing it. So this is talking about your town. It's the same article, Adam. In Austin, the average out-of-town home buyer had a budget that was 32% higher than the local residents. And
that sounds right.
Of course, what this look, one of the things I was teaching in our conferences way back in 2004 was the idea that you need to be very careful taking your California brain to these other markets because everything looks like it's free, right? All of the houses seem so cheap compared to where I lived at the time, Newport Beach, California. And that was the audience I was mostly talking to back in the day. And so that's what you have. You have like this instant wealth effect that is created by geography. And so people are willing to be more liberal with their spending when they look for a house in any of these other markets. And we've seen that for almost 2 decades now.
Yeah, our realtor sent us a thing for our house, and it was hilarious whenever she said, here's how much it's worth. And it was essentially, her email said, and I don't remember the exact numbers, but she said, your house is likely worth $750,000 to $800,000. I would expect it to sell for about $950,000.
That's a very interesting statement. Speaking of the incredible market and how important it is to nurture these assets and to own income producing real estate, it's just the most historically proven asset class in the entire world. You also want to make sure you protect it. And I'm putting a link into the chat, so you should all see this here. And it's just about our fantastic asset protection web class. This is about an hour and 20 minutes long. You will learn a lot. It's given by an attorney that we've done a ton of work with. He's been great. Our clients absolutely love him. And you can just check that out. Just check it out for free. It's at jasonhartman.com/protect. You'll learn a lot. And if you decide to hire him to set up entities, a trust, an LLC, corporation, land trust, his prices are a bargain, the bargain of bargains, because he's a real attorney. This is not one of those hokey services that's a boiler room where you can't get any real advice. He does a whole plan for people. He provides them with a chart showing the way they should structure their entities. It's just awesome. Go to jasonhartman.com/protect. And A. Hale is from Romania. I remember when I was in Romania. I've been to 87 countries now. And I was there. Actually, this is kind of an interesting story because I was there on a day when it was so hot in Bucharest. I think I got heat stroke, whatever the real definition of that is. I don't exactly know. But I remember coming back to my hotel in Bucharest. It was the Intercontinental Hotel, and turning on the TV and watching as the Great Recession began to unfold. Yes, I was in Bucharest, Romania at the time, and I remember seeing these stories about how big mortgage companies were failing, and that was the beginning back in 2007, 2008, when all of this was just unfolding, and the money printer was just about to go into overtime. And if you think that was a lot of money printing, based on the past year, it was a drop in the bucket compared to the last year or so, right?
Yeah, so we got this one from Jen Wu Lee said, Edmonton, Alberta, Canada in the house. Crazy how much valuable content you bring, Jason and Adam. I'm learning more valuable information than my 5-year degree in chemical engineering and what universities teach. And hey, he actually at least went to school for a useful degree.
Right. Yes, I'm very glad, Jinwoo, that you got a real degree that has real value in the world, and that's a real STEM. That's where it's at, folks. STEM. Nobody's hiring for feminist studies except the government. The government's probably hiring for them, but the government isn't a real employer. Okay.
and Ravi said, I'm from OC. Jason, completely agree, but I can't find anything with a decent cap rate in a nice area in Austin, Fort Lauderdale, etc. I'd love to invest in LA. I don't know if you mean like LA,
No.
California, or Louisiana, but most of it's cash flow neutral.
Well, there's another LA, Adam, and some people don't know about it, but there's an area called Lower Alabama, which is LA also.
Oh.
Okay, just so you know. And the prices are much lower, and we have properties there. So reach out to our investment counselors through jasonhartman.com or call us at 1-800-HARTMAN if you're in the US. But yeah, Ravi, absolutely. I spent most of my adult life in Orange County. I grew up in Los Angeles as a kid, and then built a big career in a company that I sold to Coldwell Banker in Orange County, California. I lived in Irvine, Newport Beach, Newport Coast. And you can't even come close to doing any deals that make any sense really in California. And Fort Lauderdale and Austin are way too expensive now. Now, what's interesting about that, though, is our network, over the years has helped hundreds of people, maybe thousands even, invest in some of these markets that we can't touch today. Austin would be an example of that. It's just too expensive. They've become either hybrid or cyclical markets that are just too pricey. You can't get the cash flow to make sense. Nothing makes sense. So, reach out to us, go to jasonhartman.com, click on the properties page, and you can see the markets that still make sense there. And those markets, I would argue, will not make sense at some point. They will also become too expensive to make sense, and then people will go to another tier, and they'll go to even lower price, like third, fourth, fifth tier markets or submarkets that where they can get properties that will cash flow that make sense, because
I will say
it's going crazy.
Robbie, we've got some stuff. Check in with, if you have an investment counselor, check in with them. If not, reach out to us. We have some stuff in the San Antonio, New Braunfels area, which is about an hour south of Austin. Really nice area. I kind of wanted to live in New Braunfels for a while, but didn't work out. So, there's stuff in the Austin area. So, contact us, check it, and we'll see if we can help you with anything. So, I believe now we get to, Jason, you have this one where Lisa in the inner circle said, has anyone had a tenant turn lately? How much of a rental increase have you seen in the past year? And I want to update on the live stream we did 2 weeks ago when we talked about rent increases. I contacted my tenant in Jackson that I'm self-managing.
So that's Jackson, Mississippi.
Jackson, Mississippi. And like we said, they were running for $750. I probably could have increased it more, but I got $100 increase because I knew if I went over 100, I know their finances, and over 100 would have stretched them. I might have lost them as a tenant, and I liked them as tenants so far. So got $100 increase on a $750 rent.
Right. Which is incredible. And those are little cheap houses. We really don't have much of
Yeah,
that kind of inventory at all anymore.
bought that a couple years
Um,
ago, whenever that
yeah,
existed.
yeah, absolutely. Do you remember what you paid for that house, Adam?
That house we paid, I want to say we paid 70 or
Oh,
75,000 for it.
don't even mention that because everybody listening and watching will get really upset that they didn't buy tons of those little cheap houses at the time because they're almost non-existent. I mean, look at they exist, but they're now a lower. They're like two tiers below that. They're in really, they're really not quality inventory. So, now most of I'd say, what would you say our average sales price is nowadays, Adam? I
The
would.
average, if you include the rehab properties that come in and the new construction, you're probably looking at an average of around 190 to 200. If you look at just our new construction, it's probably about 230, I would say.
Yeah.
So there's really a huge gap. There's the new construction stuff that's probably about 230. And then there's the rehab stuff that comes in that even today is probably averaging about 120, 130. But that stuff just, I mean, it's rare. And when it comes in, it's gone. Like, you need to be pre-approved and just tell your investment counselor, I want to buy the next house that comes available. And
Yeah.
then you might get it. So.
Yep. That's right there is an example of Adam being encouraging. Yeah, it's absolutely ridiculous. And by the way, I just want to state for the record, like I have many times, we hate this type of market. This market it's just too hard to operate in this type of market. Okay. Things are going too fast, too many clients that are, ready to buy. They get discouraged because they get beat out on properties. I mean, much less so through our network than they do in the, open marketplace, where they're going to have bidding wars. I mean, it's just absolutely crazy, but it is really hard to operate in this kind of market. I'm looking forward to seeing a market at some point in the future where there's a little more inventory, where interest rates are actually a little higher, so things aren't at such a fever pitch, because this is a very difficult market in which to operate. But go to the next slide, if you would, Adam, because the important things are on this next one. So look at this. Now, here's the lesson on this one, folks, is typically, rents always lag prices. So there's a lot of upward pressure still on prices, but there's also a lot of upward pressure still on rents. But you don't see the rent thing because it's like an iceberg with most of it well below the waterline. And with this, you get landlords are able to raise the rent once a year when that lease comes up for renewal, right?
And you may not even know. If it doesn't go to the market, you don't even know.
Right. And so what I'm saying is the tenants you have may not be able to afford what your house is now worth in terms of rent. They may not. So you may have to just raise the rent, lose the tenant, re-tenant the property, and you might end up getting $200 or $300 more per month on these little cheap properties, right? These aren't expensive properties. I mean, when we talk about these numbers, we're not talking about expensive properties that are $500,000, $700,000 or more. I mean, these are anywhere from, at the very low end, maybe what would be like the least expensive property we would have nowadays, Adam? Is there anything that ever comes along for, good quality, 125,000?
Yeah, not very often.
Okay.
I would say if you're looking for a quality thing, I mean, if you waited for a year, you could probably get two properties that were $80,000, or there'd be two that you could try to get for 80,000 that are nice, and that'd be about the lowest you can go.
Okay, but mostly you're going to see stuff around $200,000 or so, give or take, probably a little higher, and that's what we're talking about. I mean, where you can see a rent increase of $200 or $300 per month. When your tenant leaves, it might be the best thing that ever happened to you. Normally, we want to minimize tenant turn, of course, because turning tenants is expensive. But in a market where your rent is really a lot higher, and you may not be able to realize that rent with the tenant you have, you may not be able to realize market value. it is a sign that we are having real inflation in the economy. And what does inflation mean? Well, it means many things, but one thing it means is a decline in the standard of living, a decline in the standard of living, because prices inflate and people can't keep up. And sadly, most people can't keep up because they don't follow our plan. They don't invest in income property. They don't use inflation-induced debt destruction. They don't make inflation work for them. It works against them. So your tenant may be in that position, and you're going to literally witness their standard of living decline, because if your rent is $1,200 a month, but you can raise the rent to $1,450, that's the market value, and you raise that rent, and the tenant says, "I can't afford it. I have to move." And they move out, they go get another house that's $1,200, that's going to be a much lesser house than the one they rented from you. And that is showing us right there how inflation really causes a decline in the standard of living for most people, sadly. But it doesn't for you, because you're doing the right plan, because you got educated, you took action, and you bought assets that inflation hedge, but also have this beautiful quality of inflation-induced debt destruction with this self-liquidating debt. You're basically doing what the corporate raiders did, as you started to learn about that way back in, or from, if you're depending on how old you are, the 80s, when you heard about, that was the first, remember the first movie Wall Street, right? Remember Ivan Boesky back in the day, and T. Boone Pickens, and all of these people, Carl Icahn, these corporate raiders. One of the things they would do is called an LBO, a leveraged buyout. And that's pretty much the way rental property acts. Income property acts, if you do it right, if you follow our plan, like an LBO, a leveraged buyout. And it is a beautiful, beautiful thing. Okay, Adam, let's move on.
Yep. All right. So now you've got this this cheap little property here.
Yeah. So I was looking at properties for myself in Sarasota, and I still am. And I don't know where I'm going to move, but I want to try the west coast of Florida. I've lived on the East Coast for 3 years, and I want to kind of try Sarasota or Tampa or St. Petersburg maybe. And so I've got all these alerts coming up, right? And I was there 2 weeks ago in person. I looked at about a zillion properties, and this one came up on my alerts. I really don't want to spend this much. Maybe 2 million or even 2.5 if I really love the house. But, I just put unlimited in the price because, hey, I'm curious and I want to dream. And so this house comes up, and I couldn't believe it. I'm thinking on a house that's 4,100 square feet, basically. Even though it's a high-end home, you're going to get really nice finishes, and the price per square foot is going to be high. But usually that price per square foot will kind of amortize down as the size of the house becomes larger. Yet this house was approaching $1,000 a square foot. Folks, this is not Santa Monica or Newport Beach, okay, or La Jolla or San Francisco. This is Sarasota, Florida. Are you kidding me? There are all kinds of properties I looked at that are $600, $700, $800 a square foot in Sarasota, Florida. It's a great town. I love Sarasota. But are you kidding me? What is the lesson here? What am I trying to point out? I'm trying to point out that it should be very easy for you to see, as I have seen with my own rental portfolio over many, many years, that the houses you're buying now that are maybe $150 a square foot, it's easy to see that house being $200 a square foot or $250 a square foot, and just do the math of the properties, the rental properties. Hopefully you own rental properties, or you're looking and you're at jasonhartman.com/properties. And you see this property that's $150 a square foot on our website, right? It is very easy to see how that property could be $200, $250, or even $300 a square foot in the not too distant future. So, the old saying, don't wait to buy real estate, buy real estate and then wait.
Keith had a question for you, Jason. You're buying now and not renting homes?
For myself, well, Keith, if you were listening to the podcast, you would know I'm a big fan of renting a high-end home for oneself because the rent to value ratio is in favor of the tenant, and at the same time arbitraging that by owning a lot of low-end properties you rent to other people, because with those properties the rent to value ratio is in favor of the owner, investor, or landlord. But what I found when I moved to Florida and tried to rent a high-end home 3 years ago is that so many of these high-end properties have been converted to Airbnbs or VRBOs, whichever, short-term rentals. And there just wasn't much on the market in terms of long-term high-end rentals. Yes, you can rent a high-end house, a $2 million house for 10 grand a month, 12 grand a month, which is a good deal. That's a good rent to value ratio for the tenant, not for the owner. But the problem is if you can find them. So I'm mostly just looking to buy. I do have rental alerts set up as well, but I don't find that much. Okay. So I'm just probably going to cave in and buy something. I bought the house I'm living in now because I couldn't find a good high-end rental, which I wanted to find. When I left California 10 years ago and moved to Arizona, I got a really nice high-end rental, a beautiful 3,600 square foot brand new penthouse. And I was only paying $3,600 a month. I mean, that was a bargain of the century. I loved it. But I've done this a couple of times, found good rent to value ratios in my favor and where it dictates I should be the tenant. And I've done that. But it's few and far between, I'm noticing lately.
Yeah. All right. So I believe now we get to my stuff.
It's Adam's turn, folks. Okay. So Adam, tell us what you're going to talk about today.
We're going to talk about a case study on new construction returns, because we've talked about it in the past about how, new construction properties tend to perform better than the pro forma says. And then I'm going to talk about 2 times that I've found people tend to regret buying a property. So those are the 2 things I'm going to get into today. Number 1, this is the townhome that Aaron and I purchased. We just closed on it April 13th. It was signed back in August of 2021.
Aaron is your wife.
Aaron is my wife.
Right.
So this is the pro forma the day that we signed. So it was $179,900. We put everything on our website at 25% down. So you'll see here there's about a $45,000 down payment. The loan and closing costs here, total expected cash invested $53,000, $109 square foot, renting for 91 cents a square foot. So this was the original pro forma. Jason, do you think it was that whenever we closed?
No, I think the deal got a lot better, right?
So this was the original cash flow expected, a $1,500 rent. The property taxes, insurance, all of that we have, it was estimated at, there's the loan structure was expected a 4.25% rate at 25% down. And the expected cash flow of $284 with 25% down, with 8% vacancy, 8% management, 3% maintenance, a 6% cash on cash, 31% total return on investment. So a solid investment from day one. Mm-hmm. I would argue that's why we signed 3 of them, because we we saw these numbers and we liked them. We wanted
when Adam buys something, he always gets the tri-pack. Okay, he gets the triple pack, family size.
So this is actually
you do have 4 kids, so you need to get the Costco version, right?
This is a good lesson here. So the reason we bought 3, we've never bought more than 1 at a time, but the reason we bought 3 is because of the low inventory environment. We saw a property we liked in a market we weren't sure how long it was going to be feasible, because Atlanta is a hybrid market, but at the time it's making sense. And so my thought was, I don't want to expand into a market and just have 1 property there and then be waiting and waiting and waiting for another property to come up. I like this property. It's there. I'm going to get 3, 2 or 3, so that I at least have a decent footprint in the market.
I agree with that. That's good.
So that's why we jumped on this. So this was on closing day, April 13th. You'll note here, we put 20% down and got a 4.375 rate. My spreadsheet rounded it to 4.38. Our origination and closing was about $8,300. So our official cash invested was $44,282 after you factor in like our inspection, our appraisal, and all of that. So this is only $2 off our actual cash invested. It rented for not $1,500 but $1,585, and our total mortgage payment with taxes and insurance included was $1,021. At 20% down, it's expected cash flow of $273. And I apologize, that's probably pretty hard for y'all to read, but it says $273 for cash on cash, not of 6, but of 7.4%, and not of 31% total return on investment, but 37.5.
Wow. Congratulations. That is
so phenomenal. You can see here, we had an $85 rent increase. We invested $9,000 less than initially expected. Our cash flow only dropped $11, a 1.5% increase cash on cash, and a 7% total return on investment increase.
Adam, for any of your properties that you've been buying lately, have you been subject to price increases by the builder?
We got hit with our third one. Our third one was hit with the price increase, and I'm going to get into that in just a little bit. So now we're closing on another one in 2 weeks, and guess what happened, Jason?
What happened, Adam?
This was and this is what's going to happen on a monthly basis. So these properties, these markets are in such high demand that this property had a lease signed and a deposit received 4 days before the certificate of occupancy was issued.
By the way, what city is this? What area?
This is in Atlanta.
Okay. It's not Atlanta officially, Atlanta Metro.
Yeah, Union City. It's 15 minutes southwest of the airport.
Right.
So
and when we talk about areas, they're almost always the metro area, the greater metro area.
Yeah. So 4 days before anybody could legally live in the building, we had a lease signed and deposit put in. So on a regular month with no maintenance, because our new construction for at least the first 2 years won't have any, we'll be getting $437 of cash flow. That is an 11.85% cash on cash return and a 42% total return on investment. So I'm looking forward to it. So 9 weeks later, this property that we're closing on in the next 2 weeks doesn't even have a certificate of occupancy yet. They're going to get it sometime soon. Already has a lease signed and a deposit received. Remember, 9 weeks ago it was $1,585. Now it's $1,615. In 9 weeks, our rent went up $30.
Incredible. Now, the problem is some people listening don't think that's a big deal. They think $30, I make $200,000 a year. Why am I even watching this? But they don't get it. They don't know how it works. So if you're one of those people, please get edumacated. Okay, we got free edumacation for you. Okay, I'm just being funny. Well, maybe I'm not funny, but whatever. I'm trying to be funny.
He's making jokes, at least.
Yes, I'm making jokes. They're probably landing, like a lead balloon, as they usually do. But get educated. Listen to the podcast. Get that free book we've got scrolling along the bottom of the screen there. That free report, pandemicinvesting.com. Talk to our investment counselors and get some help, because these small amounts of money, when you put very little down on the property, the return is just magnified so much, and you get tax advantages, all these great things. But we just want you to realize that. Okay.
Yeah. So now I'm looking at over 8% cash on cash and over 38% total return on investment. Now remember, this was only expected to get, it said 6% on the original, but I think it was like 5.75, and it just rounded up on the pro forma. So, in the time it takes to build it, our cash on cash went up 2%. We're putting in way less money into these deals and still making, now the cash flow is expected to be $297. That's $13 more than the 25% down was when we signed. I mean, this is what this market is doing to these new construction investments. It's making them boom. I mean, we look at it and you say, oh, it doesn't look that great now. Well, look at it in 8 months, 9 months, whenever it's actually going to be built. What's it likely to
in
look
normal
like?
times, we say 3 to 5 years.
Yeah. So this is what it's going to look like since it's tenanted, and since it won't have maintenance. We'll be looking at a cash flow of $465 a month, which is a 12.6% cash on cash and a 42.7% total ROI. Now, this is, if you note here, appreciation of 6%.
Adam, I think you better just re-emphasize what you just said, because you just passed by it. Folks, Adam is so nonchalant. He's just like, oh, and we got, a 47.2% ROI. It's just 47.2%. Oh my gosh, that's incredible.
Yeah. So this is with a 6% appreciation, which Atlanta for the last couple of years has been doing closer to 8 to 10%. So it's very likely to be
in some years 12%. In some years 12%.
Yeah. So I mean, it's booming, and it's we're very happy with it. We're even happier today than we were when we signed 9 months ago. So this is what you were referring to, but were we hit with a price increase? Yes, we were. We were hit with the price increase for our third one. Like I said, it went up $10,000, but they also informed us that the next time they bring these out, it's going to be instead of $179 like we signed, they're going to be selling them for $209. So we're now signed in for $189. Edward, I see you asked here
$30,000 price increase, right?
Yeah. So Edward asks, are we using conventional loans? Yes, we are. Yes. These will be the final. This will be the 7th, 8th, and 9th loans that my wife can get from Fannie and Freddie. So she's tapped out, and we'll be buying in my name after that. Because right now you can get 10 Fannie Mae Freddie Mac loans. We refinanced out of our primary residence just into her name so that we could open up loan slots for me. And so I have all 10 free, but these will round out her 10. So we did get hit with an increase on the third one. It's still going to cash flow really well. Now, remember, they upped it $10,000, but for us, that's only $2,000 because we're financing, 80% of it. So the good news is, and sorry, Edward, I'm going to remove your comment here. This is why I am not as concerned about lumber prices and price increases moving forward. I'm going to make this a little bit bigger. But if you look at the lumber futures, it's giving me a lot of hope that for those of you who are signing today who won't be closing until end of the year. So you have to remember the price increase is going to hit when they have to buy their materials. That's when they're going to know, do we need to raise their price? If you look at the futures of lumber for July, September, November, January, March, they're dropping. By the time you get down to, a year from now, right now lumber is at around $1,500 or $1,600. So you're looking at a 36% drop in lumber prices between now and then, future wise. So this is giving me a lot of hope that we're not going to see a lot more price increases from builders. So I'm very, very hopeful that it will be protecting us. So yes, we got hit with one, but if it makes sense the day you sign it, it's going to make sense even with the increase.
Right. But just, we have to say, Adam, there's way more to it than just lumber. Okay.
Right.
Lumber is a huge component, of course, but I mean, it's just like there's a shortage of everything. Just give you another example. I mean, this is not about a house or you're going to do oil, so that's great.
Because oil holds steady roughly. It's looking at a 64 to 66% futures. I did copper futures as well because there's a lot of copper in houses.
Okay, great.
They're staying pretty steady. So you've got
remember that wiring in your wall is made of copper wire. Okay, folks.
Yeah. So if copper's holding steady, oil's holding steady, lumber's decreasing, I'm not saying your home's going to get cheaper.
Lumber's not decreasing though, really. I mean, how far out is that contract?
I mean, this is for July of 2021. Mm-hmm. This is for September, November, and January. I mean, by January futures are at 970.
does that really tell you the price? Or that's really, I mean, listen, I'm no expert on the futures market or the commodities market per se. I just know that they're the ingredients to the house that we're talking about, right? But that's just a bunch of bets is all it's really saying. It's not really telling you what the price will be.
Well, I believe it's also some builders in those groups buying out contracts for when it will be delivered.
Yeah.
So I don't know if it'll correspond directly, but it's very good. I mean, compared to what it was, in the past, year or so when we've been seeing futures get higher and higher, they've started decreasing, which is, like I said, it's not giving me hope that homes are gonna become cheaper, but I'm hoping that the number of contracts that have to have the escalation clause triggered is reduced because of these things. Because I mean, that's what the clauses are: is that if it costs us more to buy, then we'll have to do it.
Right.
So hopefully, it won't be costing them more to buy. And hey, if they can make more money as a builder, I'm okay with it because my deal when I signed it, I liked. So if they can buy lumber cheaper and make more for them and not raise the price on me, I'm game.
Yeah. Okay.
Yeah. So let's see. I believe. So, you want to take some questions, or do you want to go to regrets?
Oh, I think this is a good segue for question time. So let's go for it.
All right. Let's see. So we've got up here. We had some. Let me just get to them. A Hale says, "When do you think the prices will stop rising? What conditions should we look for?"
That is a great question, and if anybody really for sure knew the answer to that, they would be insanely rich. But my belief is that this market has really another good year and a half to 2 years left in it. Now, granted, lots of forces act upon things. If interest rates went up dramatically, if there was some unforeseen event like a terrorist attack or something like that, who knows what'll happen. And one of the dangers of this type of monetary policy that we've been experiencing is that the Federal Reserve and the other central banks around the world, they're just using all of their power. It's think of it, like all of the tools are being used, right? They would either have to invent new tools to fight another crisis, or they just can't because they've used everything. They've used all the bullets in the gun, right? And so that is the dangerous thing, and that's why they really do need to taper. And that's why we do need higher interest rates. Low interest rates are dysfunctional. They're not good for pension plans, which we're doing a video on the pension crisis. They're not good for pension plans. They're not good for older people who are savers, who've done the right thing all their life. They're not good for insurance companies. Insurance companies are, really at risk with these low interest rates. So it's dangerous. I mean, we think low interest rates are, hey, it's great. Look at how cheap my mortgage is, right? And it's like free money. And that's true, but there's another side to it. So it's not all good. It's great for real estate and other assets that are debt based.
So, Ahale, my answer is you have to look at the individual market and see what's causing the run up, and then when that changes. So, for example, let's look at we've talked about Austin. I live in Austin. I'll talk about it real quick. So, when will home prices in Austin stop going up? Well, number one, people moving here needs to slow. That needs to happen, because right now there's not a lot of building going on. There's not a lot of flipping going on because the prices are so high. It doesn't make much sense. People can't even get the distressed properties. And so with the number of people moving,
you mean they can't get the supply of properties to renovate and flip?
Right. Yeah. They're not, I don't even know if they have auctions in Austin right now, to be honest. I haven't looked into it, but
foreclosure auctions, you mean?
Yeah, foreclosure auctions. We need businesses to stop moving here, people to stop moving here, and inventory to increase before prices are even going to slow down or stop. I mean, those are the big things. If you see a market where people are continually moving in, where businesses continue to move, especially businesses that are paying people, 6 figures or more, on a regular basis, or even high fives, if you've got those people continually coming in, it's not going to lead to a market that slows down. Eventually, businesses will slow their move here. Maybe prices will get so high that businesses will say we can't pay our workers enough to move there and actually, live. And so they'll stop coming, and then people will stop coming, and then prices will slow. But the markets we're in, especially like if you look at, I can't speak to Florida because it's the economics are more diverse in the markets that we're in, but like for example, in Alabama, in Birmingham, Tuscaloosa, and like the Coleman area there, that's all primarily driven by auto manufacturing. And those plants aren't going anywhere. And the jobs are good, and people are still moving there because the state is getting an influx of people. So it's not going to be the industry changing that's going to impact the market. So you're going to have to look at population flows.
Adam, a comment on that.
Yep.
That is a great thing that you just said, and it shows why a manufacturing base is so important for any local economy where you're thinking of investing. Just look at what's happening in the Bay Area, San Francisco Bay Area, Silicon Valley, San Francisco, the city itself. People are fleeing like crazy. Now, granted, with free money, which is essentially what we have, that will buoy even the worst market, like New York. Okay. So even in New York and San Francisco, there are signs of some strength. But the fact is, the big trend, the mega trend, is that people are leaving. Why? Because it's easy for them to leave. You can move and take your laptop with you and do your job from Zoom. Okay. That you can't be an auto worker on an assembly line and leave, and the auto plant is not going to leave, right? But a software company can just say, hey, look, we're fed up with the Socialist Republic of New York or the Socialist Republic of California. We're moving to Florida or Texas or someplace that's business friendly, or Nevada. And so they'll just do it. You can just get on a plane and go. You're gone. All you do is go to jasonhartman.com/protect, open up a little corporation, and it costs nothing. Okay. After watching our webinar, and you're in business in another state, and you don't have to have the oppression of this business unfriendliness that goes on in these terrible places. But if you have a manufacturing company, it's not easy to move it. And what Adam is saying is so poignant, because these businesses aren't going anywhere in the markets we recommend. They are big. Look at Memphis, right? Arguably, Memphis is the logistics capital of the United States, right? Because why? Federal Express is there. Fred Smith's company, that he got a C- on the paper writing about Federal Express at Yale University, right? And then he said, screw these professors and their ivory towers. I'm going to go start FedEx. And there he went. And now it's history. But FedEx is not going to get up and move.
They're not going to move the freeways and ruin Memphis.
Yeah.
Yeah.
But all those companies can leave California, and they've been leaving for years, and it really became accelerated with COVID 1984.
Yeah. And like Montgomery, Alabama, it's highly government jobs because it's the capital. So there's a lot of people who work for the government there. If they start talking about moving the capital of Alabama, yeah, I'd be worried about home values and the market of Montgomery, but that's not going to happen. And if it does happen, you're going to get a massive lead up to it. Like Texas threatens to move the capital out of Austin. Not that it would matter at this point much, but they threaten that every couple of years, but because they say it's too liberal and they're going to punish us.
Punish you liberals? That's good.
Yeah, by taking the capital away, which at this point in time, take it, please. But
you want the capital to leave Austin? Are you crazy?
No.
Why?
Anything to get rid of people at this point in time.
Oh, you're just sick of being crowded.
I'm sick of not being able to drive on the roads at any. There are traffic jams at 2 a.m., Jason.
I know. Well, that's like LA. Same idea. Yeah.
All right. So Boiled Nuts said, which new markets are you beginning to see promise in?
I want to know where you guys come up with these funny names. But that's a cute dog.
So new markets, well, that's kind of deceptive. We're looking at getting back into some of our older markets. Like we're looking at getting back into Oklahoma City. We're trying to get more into Atlanta where we can. We're looking at other markets in Florida. Right now with the inventory situation, we're almost spending more time focusing on our existing markets and trying to get inventory there so that people who've already bought in their various markets can keep building up their portfolio, because we talk about diversifying to 3 to 5 markets. Well, we don't want to have people in 3 to 5 markets and us just say, well, we don't care about that market anymore. We're going to find new markets, because we want people to be able to continue building their portfolio, and the markets are still good. We're just having to work harder and harder to find properties that will work for those people in this environment. So I don't have a ton of new markets that I can say definitely go after these. The newest market we're in right now is we got back into Texas. We're in the San Antonio, New Braunfels area. We can connect you with those if you want, but we don't have any new exciting hot markets that are upcoming. We're just trying to bolster the markets that we've either been in recently or are still in but need more inventory.
Yeah, and there's enough choice, enough markets that we're in for you to build a very nice portfolio, as many of our clients have for many years. But I just want to point out, as Adam mentions, that all of these markets, not, and when I say this, it's a figure of speech. Of course, there's a deal here and there, folks. Okay, but I'm on the macro level. Whether it be Austin, Houston, these markets have become so expensive. Dallas, I mean, we used to sell tons of properties, Dallas, Austin, Houston, and we just can't do it anymore. The properties have become too expensive to have good rent to value ratios. And that will happen to all the markets we're talking about today, right? That it's going to happen to those markets too. So don't be the person who misses out on the opportunities. When the real estate, I know some people are out there talking themselves out of things because they think it's a bubble, prices have run up, but not when you compare it to other things. Like we've talked about, I've done extensive work on this. We're creating a whole new economic index called the HCI, the Hartman Comparison Index, to show you that when you compare real estate to things other than dollars, it's actually historically cheap, like I said at the beginning. So, as long as you're careful, you're doing it in the right place and the right way with our guidance, you'll be in good shape.
Yeah. All right. So, no, wrong. This one. So the gold color says, what are you then looking at on emerging jobs to fulfill these rents in those areas? And we talked about this a little bit. This is more your tenants. As rents go up, they might have to go down to a lower class property, and you might be getting people on their way down who couldn't afford they were renting a $1,600 place that's now $1,800 or $1,900, and your $1,400 place became a $1,600 place, and they just swap. So that's really who we're catching whenever it talks about rent increases. You might, and like Jason said, you might have to lose your tenant to do it, and that's just kind of the way it works.
Yeah.
Yeah. So Robbie's back, and Robbie says, do you both recommend new construction developments and using the Burr Refinance method, or just buying turnkey property, or maybe a little of both? One has holding costs, but money comes back.
Do you want to take it, or do you want me to?
So I don't know about the Burr Refinance method on the new construction, because we're getting conventional financing on the new constructions. So I'm not 100% sure how the Burr Refinance method would work there. I don't personally have any interest in doing Burrs at the moment, especially in markets outside of my home. I don't even feel comfortable doing it in Austin, but I would rather just buy turnkey, pay the little bit extra, and make my good solid returns, rather than going through all the flipping business and the rehab business that you'd have to do.
Yeah. So you can we're starting to teach our clients how to do Burr, but you might keep them but also you might sell them, and you can sell them back to our investor audience. So if you're a more active person that wants to go out there and find deals and fix up properties and do all that good stuff, we are now teaching people how to do that and helping them do that so they can sell those properties to our turnkey buyers in our network, and trying to create that ecosystem. So, yeah.
So the gold color said, Jason, coming down I-5 California, we saw train loads of wood coming down the tracks. There might seeing all those, you might start getting some new like train robbers.
Yeah, actually,
armed guards next to them.
The new bandits that are stealing lumber, right? Yeah, yeah, absolutely. It's possible. But what you didn't see is you didn't see enough train loads of lumber coming down the tracks. You saw some, but they needed more than whatever was on that train. I can guarantee that.
Yeah. Johnny wants to know, does USA have variable rates for houses too, like Canada? You can get a variable rate loan, but with today's rates, there's not a whole lot of upside to doing that at the moment. Because if your adjustable rate might be lower, but who knows what it's going to be like in 5-7 years whenever your fixed rate comes in. So it's not likely to be fixed at anything lower than it is now. Most likely it'll be higher.
We like this super cheap 3-decade long money, where you're not making your last payment on that mortgage until 2051. Think about that. Just really let that sink in, and think about how much inflation is there likely to be between now and 2051. And I'm going to play a message from one of our clients.
I was just about to ask, you're going to play Andrew's.
It's on the podcast. I'm going to play it here for you. So let me cue it up. Find it, Adam. Go ahead.
All right. So in relation to that, MC says, is 20% lowest down payment on investment homes. You can get, Freddie Mac has a program where your first 6, you can do 15% down. After that, you have to do 20% down. So you can get in for 15%. I don't know the rates because it didn't make sense whenever I was talking to the lender for me to think about doing it. I don't know the exact rates. I don't know how much the PMI is, but you can get in at 15% for your first 6 loans. That is a possibility. So just know that.
I've got it for you. I've got it queued up. So this message, well, let me just make sure the speed is right.
Say 2.
Okay.
Because I was looking at the amateur.
Okay, hang on. Okay, so this is from our client, Drew. Now, if you're a regular podcast listener, you've heard Drew on the podcast over the years many times, because he is really taken on self-managing his rental properties that he's purchased through our network. And so he's just been a real contributor to the audience, sharing his experiences and all this kind of stuff. And he's been very helpful. But he just bought a new high-end property for himself and his family, and he's real excited about it. I think he paid like just under $2 million. And this property, he did the amortization schedule. It went online and looked at the calculator and realized something. And I'm going to play his message to me from 2 days ago. I'm going to play it for you now. Listen in.
Schedule of a $1.5 million loan in 30 years, you only pay back like half of it in interest. So like if you borrow $1.5 million and you pay it back in 30 years, you're only paying like $750 and $750,000 in interest. I mean, so in 30 years, you don't think you can make 50% on your money? I mean, hello, how much is inflation going to be in 30 years? I mean, it's probably going to be way more than 50%. So yeah, free money.
Isn't that incredible? That he's so right about that. You can borrow $1.5 million in our world. That means you can buy, 6 to 10 properties, pretty reasonably. And you borrow that money, you're going to pay about $750,000 in interest. And most people, because they're stupid, think that's a lot, but none of you listening think that, because you get it, right? And so you're going to pay about half that in interest over 3 decades. You can do way more with that money than they're charging you. So what Drew is saying is, yeah, it's free money. That's basically what we have now. We have an environment where we have in real terms, meaning on inflation adjusted terms, negative interest rates. You're borrowing your money on your mortgage at below the cost of inflation. Plus, and that's if you were paying the debt back yourself, but you're not even paying it back yourself. You're telling your tenant to pay the debt for you and give you a tip every month called positive cash flow. So yeah, it's a pretty great equation.
All right. So John Knight wants to know, is using a HELOC for a down payment a bad practice, Jason?
Well, it depends. And what does it depend on? So I assume you've got a personal residence with a bunch of equity on it, and you're thinking, do I go get a HELOC, a home equity line of credit, which is typically an adjustable rate mortgage that's in second position to your first mortgage, and use that money for down payment on other rental properties? The answer is, I don't know for sure because I don't have enough information, right? I might rather, but I don't know because I don't know your exact situation. I don't know how much the home is worth. I don't know how much the current loan balance is. I don't know the rate of that current loan. And I don't know the rate with which you can borrow HELOC based versus cash out refi on a fixed rate loan. And I don't know how long you're going to stay in the home. So there are lots of variables like that. And I don't know where that house is located. So if it's in a cyclical market, I would argue that you ultimately want to get out of that cyclical market. And that's probably a business unfriendly market and an overtaxed, overheated, overregulated, overcrowded market like California, New York, et cetera. And there are others, not just those. So with all that said and all those variables understood, you want to compare. So first off, generally speaking, yes, you want to strip equity out of your properties and use that equity, turn it into cash to buy other properties that are good, sensible properties. Yes, you want to do that, generally speaking. However, you might want to just refinance the entire house and get one single loan that is a fixed rate loan for 3 decades. Okay, get a nice 30-year mortgage, and it'll have a lower rate. And what you want to look at with the HELOC and the first mortgage that you appear to have now is you want to look at what's called the blended rate. So when you weight the amount of each of those loans and then you factor in the interest rate, you're going to look at the blended rate. What is the rate of both of them? But the problem is it's really hard to do a good blended rate study on a HELOC, which is likely an adjustable rate loan. So talk to one of our investment counselors. They'll help you work through that. Okay.
Yeah. All right. So Daniel, I'm going to take the Daniels and then we'll go to the end of mine. Daniel wants to know, can you guys explain how home prices are able to rise so much faster than people's wages year after year?
Great question, Daniel. Well, the home price doesn't really matter. What matters is the home payment, not the price. Okay. So when you look at the payment, it's actually still cheap. That's the thing. Okay. That's the thing you've got to consider. So I want to just pull up a chart for you and share it with you. This is a new chart I have not shared yet. So I might normally say at the risk of repeating myself, but I'm not going to be repeating myself. And Adam, can you stop sharing your screen? Or wait, let me see if I can. We've got dual screen shares going on here, folks. Let's see if we can pull this off. I don't know if this will work. We'll see how this works. We've never done this before. Hey, I think it's going to work. Oh yeah, you can. Wow, that's really cool. Can you take away the question though?
Yes.
Okay, because I need the whole chart here. So look at this. This is part of the HCI, the Hartman Comparison Index. Okay, and what it shows you is that back in the year 2000, 21 years ago, folks, 21 years ago, if you wanted to pay your mortgage in something other than dollars, right? If you wanted to pay in something other than dollars, you have a choice of some other things you could use except dollars, right? And some of those things are shares of the S&P 500 index. So in shares of the S&P measured by the SPY, you can just look that up on any You can look it up on your phone in the stock app and look up the SPY. Well, in the year 2000, it would take you just over 11 shares of the SPY to make your mortgage payment for the median price home. But today it only takes you just over 3 shares of the S&P to pay your mortgage payment. So my question for you, is the house cheap or expensive now? It's cheaper than it was 21 years ago when measured this way. Okay, well, what about based on wages? That was your question specifically. Based on wages, the mortgage payment in hours worked at the average wage 21 years ago to make your mortgage payment, it took 69.2 hours. Today, it only takes 47.5 hours. Is it cheap or is it expensive? It's cheaper today than it was 21 years ago. Now, even minimum wage. Now, people making minimum wage aren't buying a house probably, but if they did, here's what it would take. 21 years ago, it took 192 hours, obviously I'm rounding, to make your mortgage payment at minimum wage. Today at minimum wage, even though everybody's saying minimum wage is way too low, it only takes 165.47 hours. So is it cheaper or is it more expensive? See, the house price might rise faster than wages, but when you adjust for inflation and you look at the more important question, which is the house payment, you see that it's actually quite a bargain. Adam?
Yeah. I was also going to say, Daniel, we need to remember that it's not like we're building a new home for every person who wants one every year. There's a continuous backlog because we have not been building enough homes for the U.S. in 30 years or so. So there's a continuous backlog of people wanting to get in there. And so you have home prices rising because there's just a competition. I mean, people are having to move up or move down in their price range trying to get in because at some point they just want a house. And there just aren't enough. I mean, we should be building, 2.5 million properties a year, new home construction wise, most likely we could probably do 2.5 million for 7 years and maybe get back to even. And we're nowhere near 2.5 million right now. We're more at like 1.7, 1.8 million. So, I mean, it's a massive increase that can be taken in by the market. So I see what you're saying, how people buy based on the mortgage payment, but taxes, insurance, utility bills, and the cost of maintaining the home does keep increasing. But people just want to buy, and there's just not enough to buy. So it's still happening. So that would be my response, is they just settle for less or they save up longer. And, that's a big part could just be their down payment.
I'm so glad you said that, Adam, because that's what happens in reality. People just settle for less. In an inflationary environment, the standard of living has to go down. That's the reality. So when people make these like glib statements that they haven't really thought about, like I hear this one all the time. Well, Jason, housing is getting so expensive that people can't afford it anymore. Well, what the hell does that mean? I don't even know what that means. First of all, who can't afford it? I mean, what? Like, it just doesn't even make sense. Well, the rents are going up so much. What if tenants can't afford to pay the rent? Well, then they got to move to a cheaper house. And the tenant for your house is going to be someone coming from a more expensive house moving down. Okay. It's not called the socioeconomic ladder, for nothing. It's a ladder. People move up and down the ladder. Okay. And the standard of living just declines. They get a smaller house in an inferior neighborhood with finishes that aren't as good. Maybe there's holes in the roof and, all kinds of stuff, right? I'm just kidding. Hopefully not completely, but you just get less of a house and the standard of living declines. That's how it works. So it's just
all right. So speaking of that,
let's wrap it up, Adam. You got this regret part. Yeah.
So when do you regret buying a property? And this is not going to be what most people are thinking, I don't believe. I found 2 times that pretty much everybody regrets their purchase. Jason, do you want to take a guess at one of them?
Well, how about the purchase they didn't make?
This is it's pretty close to that. The day you sign the contract. The day you sign the contract, you will feel regret and you will question yourself because you'll start looking at the deals that you're forsaking all others for this one deal.
Yeah.
So you will regret
that buyer's remorse, folks. Everybody
Yes.
gets it. Yeah.
So that is number one. And there's a second time that I'm not sure you'll get. Any guesses on the second time in the buying process you regret? Hint, it's not when you sign.
Okay, it's when you close and you
No,
feel
not
that
closing.
sense of responsibility.
you a
You know,
hint.
when you sign your loan docs? Oh, when something happens.
No,
Natural
before.
What?
The day you get your inspection report.
Oh, that's good. Yes.
This is the day, and this is very, very important for especially in our network. Remember, these providers, well, new construction, you just send it to them and say, hey, you guys missed this stuff. These providers are offering properties that are turnkey or close to turnkey. They know what you're expecting. Some things do get missed. Sometimes they short it. It's important to remember when you get your inspection report, that is not a must go forward, or must stop. This is a time that the negotiation reopens. And you send your report to them and say, hey, you need to deal with these things. So don't see it and say, oh, they didn't fix that, then I'm out. You send it to them and you say, hey, you need to deal with this, this, and this. You need to decide for yourself, what are my deal breakers? If they don't do this, I'm not going forward. If they say no to these, I'm gone. If they say no to these, I'm not going to be happy, but I'm going to move forward. These are the things that you need to go. But these are the two times I've noticed in all the workings with clients, no matter what, even my own personal purchases, you get the inspection report, you look at it. I'll give you an example. The one we closed April 13th, the new construction, we got the inspection report back. For some reason, one of the stairs, they hadn't put the facing on. I think it was the top stair. Didn't have the wooden facing that it was supposed to have. My immediate reaction was, well, then what else is wrong with this place? How do you miss that? How is it possible? And then I thought, well, it's possible because there's 1,000 other things that have to get done. It got missed. It got fixed. Not a big deal. So even on new homes, there are little things that happen here and there that need to get fixed. But when you see the inspection report, you will question, but you got to just push through it. So I believe, oh, there's one more thing. Oh, you added this.
I did. Yeah.
Don't wait to buy real estate. Buy real estate and wait. Oh, you added a bunch more stuff. So why don't you take it?
A couple of things. I'll talk them through. So,
Okay.
like Adam said, we started off with this meme, and it's so telling. The couple is saying to their realtor, "We'd like to look at something that's a little bit higher priced." And she says, "Okay, I can show you the same home again tomorrow." Right? That's what we started with today. And remember the famous quote: "Don't wait to buy real estate and then wait." There's lots more to this, folks. We've got a ton of free content for you. So check out the YouTube channel. Now that's your cue to switch the slide at. Okay. Hey, folks, it's hard to find good help these days.
This remote spreadsheeting is a different beast.
That's true. That's true. So lots of great stuff on the YouTube channel. One of my videos has probably 700,000 or more views now. It's about inflation, and it really goes into this in depth. So check out the YouTube channel, subscribe, like. Oh, and please click the like button, folks. We need you to click the like button for us. Click the like button right now. And we'll help you learn about the refi till you die technique. There are videos on that on YouTube and on the podcast. Lots of great stuff there. And I think there's one more left, Adam. And be sure to get the Pandemic Investing mini book. This free report is available at pandemicinvesting.com. There are no strings attached. So it's just there, no shipping, no credit card numbers, no BS. It's just free. It'll be emailed right to you. So go get that Pandemic Investing mini book that we did that'll elaborate on a lot of these great concepts for you. And we just want to say thanks to everybody for joining us. And Adam, thank you.
You took out my final slide.
What was that?
Oh, I just wanted to rub it in the Forbearance Bros face, the Crash Bros face. Forbearance is down even more than it ever was before. It's at record lows and people are exiting like they haven't exited before.
Oh,
So
sorry, I took that. I didn't mean to take that slide out.
you probably just posted a picture over it accidentally, or
Yeah.
maybe I was doing it late at night. I might not have even done it. But yeah, it's forbearance keeps getting to be less and less of a thing. Throughout, as the days go along. Let's see, the latest one that I saw, I'm pulling it up now. Mortgage forbearance drops to 4.36%, exits pick up steam. Loans are the number in are half of what they were in May of 2020.
Yeah.
So it's the 10th consecutive week of decreases, and the exit rate is increasing.
Right.
So
don't
wait on that inventory, folks.
Don't worry about these moratoriums and forbearance thing, at least not yet. It just has been like a non-issue for us. We were very worried about it last year, but it's just really turned out to be kind of a non-issue. Much more applicable in the multifamily apartment genre. So that's been much more of a problem. So folks, let's wrap it up. Pandemicinvesting.com. Thank you for all of you. Thank you to all of you who joined us. Thank you for your great comments. Thank you for smashing the like button. And thank you to Adam for all of his great content and great co-hosting. And happy investing. Reach out to us. We'll be happy to help you. The main website, jasonhartman.com, or 1-800-HARTMAN in the US. And all of our investment counselors are standing by to help you with lots of great advice and consultation. Thanks again, everybody. Happy investing.